My next guest says overall trends remain stable. His consumer survey suggests spending decelerated in October. Joining me now is Simeon Gutman, senior retail analyst at Morgan Stanley. Simeon, it's great to have you on. And I love the report we just got from Steve because I think that's a good place to start. And that is the state of the consumer right now in real time coming out of October, where we had a dearth of data, and how it sets us up for the holiday season.
So the consumer stable, that was our headline. You've had a very bifurcated and lumpy 2025. The beginning of the year was tough. Weather didn't help. Then we had tariffs. We had a lot of spending that got concentrated into the summer months. We had a little bit of a decel, and now we're dealing with a lot of different factors, government shutdowns, SNAP delays. We're lapping tough weather comparisons. We had hurricanes last year. So it looks like the consumer's fine overall, but we've had some bumps. And October, our data looks a little bit bumpy, but for all of those reasons that I just pointed out.
So where are consumers spending, and how much of this is a reflection of higher prices and having to spend more on the tickets themselves versus strong, or we'll say stable, demand?
But first, they're spending everywhere, but you make a good point. What we're seeing in data, especially across the consumable categories, so think grocery, think about dollar stores, the amount that tariffs are inflating price is exactly offsetting how much units are going down. So we're seeing a total level of spend that's relatively stable, but you're seeing the consumer make these trade-offs. They're buying fewer units to account for a higher price. The categories that are healthy, Steve pointed out the home category is a little choppy. That makes sense. We don't have a lot of home turnover right now. Consumables are healthy. Consumer electronics, healthy. Sporting goods, healthy. I would say most categories look pretty healthy, and if any category, home furnishings, very healthy. We had among the highest same-store sales of the entire home furnishing universe that we've had since the post-COVID period.
Are consumers shopping with things like tariffs and potential impact to prices in mind, or are they sort of shopping the way you would expect them to shop at this time of the year in general?
So we published this Wave 70 of our Consumer Pulse survey. It's a Morgan Stanley research-wide survey, and it basically jumped by 10 points, meaning consumer intention because of spending with tariffs jumped by 10 full points. We haven't seen that worry actually since April. Look back in the survey history when we had prior tariffs. So it's definitely on consumers' minds. You're going into holiday season, and we're probably stepping into a higher run rate of tariffs in the next, call it, couple of months. The July tariffs are going to run through retail, and they're going to hit pricing in the next couple of months into early next year.
So what are the names that you do like in this environment?
So we like and continue to like Walmart. The story of retail over the past couple of years has been this narrowing of market share. We call it the funnel. So fewer players are garnering a bigger concentration of incremental new market share. Walmart is one of the biggest winners of that. Plus, as they get more of that market share, it's funneling through into greater and greater rates of profit. So their ability to grow margin while the sales dynamic is occurring is present. The market knows this, but Walmart's growing faster in general merchandise categories, which are more lucrative for them. So they have this new flywheel. It's the 2025 version of their flywheel that's working. They're also a relatively durable stock in tougher times, if that's the direction the economy goes. So we still like Walmart. We do like Costco. Costco is that durable compounder. The higher income consumer hasn't really shown as much stretch than other consumer segments. And Costco does provide monthly sales. Their business is relatively stable. And we like the optionality that home improvement gives. It's been a couple of tough years for home improvement. We know we're waiting for more favorable mortgage rates. In theory, the Fed is helping that cause, moving in the right direction. But it doesn't feel like demand can get any worse. So you get the optionality if demand rebounds. Both Home Depot and Lowe's look like pretty interesting plays.